Welcome to Nasdaq Trade Talks, where we meet with the top thought leaders and strategists in emerging technologies, digital assets, a regulatory landscape, and capital markets. I'm your host, Jill Malandrino, and joining me on the desk at the Nasdaq market site is James Aubin, Chief Investment Officer of Ocean Park Asset Management, Chris Doran, Head of ETF Distribution and National Accounts at Westwood, Brian Weinstein, Head of Global Markets at Morgan Stanley Investment Management, and William Helm, ETF Portfolio Manager at Goldman Sachs Asset Management. We're here to discuss what factors are driving investor demand for actively managed ETFs. Gentlemen, it's great to have all of you with us. Welcome to Trade Talks. Welcome to MarketSite. James, let's kick it off with you. ETFs, they are becoming table stakes for active asset managers.
That's right. I think every asset manager has to be considering ETFs if they haven't already launched one. It's becoming demand from advisors and individual investors is really driving that shift away from, say, traditional SMAs and mutual funds into the ETF space. So we expect that to continue, and we're still in the very, very early innings of that.
Yeah, and it's interesting, Chris, when you think about the evolution of ETF usage by advisors, I think that's really been part of what's driving the demand here as well.
Absolutely. I like to break things down into gens. So Gen 1 were advisors, the ETFs first coming out, and it's really was just a very unique way in a unique wrapper to get broad exposure to the market. And then the Gen 2 started to kind of step outside that box. You start to see smart beta became a word, thematic ETFs, little nuances there. And now Gen 3 is just fueling it. You take a look at what's happened in the last couple of years. Fixed income has really stepped up, and there's great ways to get exposure in the fixed income markets. Cryptocurrency, whether you like it or not, it's here, and it's an asset class that I think is going to do well, and we get that exposure. And then definitely the active ETFs. And I think what's active, we can obviously have a whole discussion today about actives, but there's a variety of different actives, active ETFs. But I think innovation, as long as innovation fuels that, I think we're well off to the races. We're going to have a long run with active ETFs.
Right, and Brian, to Chris's point, investors, there's the demand there for alternative investments outside of the traditional fixed income and equity portfolio. They want to get returns that are not necessarily correlative to the markets.
No, that's right. I mean, it's an amazing generational shift from the old mutual fund into ETF world. And once you reach the crypto domain, you can start to think about private assets in ETFs. Yeah. You can start to think about lots of different things. And listen, investors love the vehicle, right? It's tried and true. We know liquidity is going to be there. It's actually changed the way fixed income trades completely, and it's going to continue to revolutionize markets and allow investors to get the different alphas and betas that they want across asset classes we probably won't even touch on today. So yeah. It's amazing to watch, and as you said, we're at the beginning.
Right, and William, I mean, the point is that it's democratizing access to asset classes that investors may not have had the opportunity to get exposure for, yet it's just a fraction of the industry.
Yeah, that's right. When you look at the active ETF industry, represents less than 10% of total ETF assets. So there's runway to grow there. But specifically from the active ETF standpoint, globally, active ETFs represent roughly 3% of global active assets under management. So we think there's a lot of room to continue to see growth in this space.
Right.
Yeah.
I'm sorry.
It's true, right? I mean, U.S. is on the cutting edge of this. Europe is catching up, and then Asia a bit behind. So you're right. I mean, this is not only beginning in the U.S., but Europe is going to follow, and Asia is going to follow that. So it's very, very early. I don't think people realize how much more there is to do in ETF space.
That's the question, right? So I mean, there's thousands of ETFs. What if you're a newer player entering the ETF market? Is there an opportunity there? Are there barriers to entry?
Yes. I mean, if you think about why active, why now? You have to remember that the rule changed for ETFs in 2019. So prior to that, it wasn't really practical to have actively managed ETFs. So ETFs have been around since the early 90s. And only now have the product development really begun there because of this rule change. And we still are in, there's about 1,600 active ETFs now. And of those, only, I would say, a third of them have a track record longer than 3 years. So definitely early innings, and like I said earlier, every active manager is looking at this as a potential distribution opportunity.
And I'll just go right in on the barriers of entry. Anyone can do an ETF. Anyone can be an ETF sponsor. Doesn't necessarily mean you're going to succeed. You need to be in the business. And you need to do everything about the business from the CEO all the way up, fully committed. The other thing I think, it kind of dovetails on several things we're talking about, is I'm just going to go back to that innovation. What you don't want to do as an ETF issuer is come out and say, me too. I'm going to be a copycat.
Right.
There's 6 of those. Guess what? Now there's 7, but here's my twist. I think that's just a bad business decision. And at Westwood, we're looking at the advisors. We want to add value to the advisors and not complicate or confuse them, and even in the ETF marketplace. So you don't want to be the copycat. You also don't, I think you don't want to, your value is, oh, we're 2 or 3 basis points cheaper. That's nice, but that's not a way. That's typically what I would think. That's a big, for the issuer to kind of do an asset grab. I think and there are a good number of these smaller boutique ETF issuers that are bringing innovation, like in the fixed income, in the crypto, in the derivative market space. So I think that's the best way to do it, where you want to solve for problems and provide a solution for advisors in the portfolio. So I think that's the key thing for anyone to do that, because I think it's needed. It's going to fuel success. And obviously, for that issuer, they're going to have success.
I mean, that is such a key point. I want to jump up and high five you. Providing a solution to a problem, which is, I would imagine, why you're seeing options overlay strategies for advisors, where I mean, it's impossible to be able to replicate those like you're seeing on an institutional desk. So I can't imagine why an advisor wouldn't want to leverage some of these strategies.
No, listen, I love seeing it, because growing up in fixed income, I mean, equity derivatives are hard and complicated, but some people had access to them. Fixed income derivatives, selling volatility in fixed income markets, really hard for individual investors to do. So you're seeing all these changes, and investors are flocking to places they can get yield or create a different income stream that might be less correlated, and is totally democratizing and giving access to what is a very complex thing that actually most investors probably have day jobs, right? They should go and worry about those. You don't want to be trading your delta, your beta. You need someone to do it for you. And so it's great to see. I love, as someone who grew up in fixed income, I love the way it's giving people access to things that you had very, very limited opportunities to get to before.
William, would you say a return to volatility in the marketplace is also good for active managed ETFs?
I think so. Anytime there's dislocation in the market, there's going to be an opportunity for active managers and their performance to shine. We really think about active products in 3 verticals. We think about access. Can you provide exposure to harder to reach markets, harder to index markets? We think about alpha. Are there opportunities in certain markets to deliver outperformance versus an index? But we also think of active as outcome oriented, coming back to those option strategies, thinking about defined outcomes, looking to service the income needs for investors.
Yeah, and so you're seeing that shift from passive strategies to more active. I mean, is there growth within the active space?
There is. I mean, the equity market's been especially hard this year, right? Because you have the 7 equities, and if you're active, you might not be overweight those, and all of a sudden you look silly. But on a longer run basis, I do think you will see equity managers differentiate themselves in both good and bad ways. On the fixed income side, I do think active is tremendously important. Remember, debt defaults, right? That's the thing about fixed income, is you get par back unless you don't. And so when you buy an index of debt, you're buying the companies and the countries that have the most debt. Might not be the best strategy.
Yeah, I mean, why would you want to own a portfolio of
all the worst stuff?
It's expensive for a retail investor to execute
and
those
you have
types
to
of
do research,
trades,
you have to execute it. So the fixed income
yeah.
space should be happy hunting grounds for investors and creators of ETFs to meet and find solutions.
Yeah.
And I was going to go back to where you're looking at these option writing or option overlay strategies. It's amazing, because I know Westwood, we have an energy ETF listed, and we do the covered calls. So the way we would look, what we're trying to solve for is an alternative income stream for that advisor that's low correlated, because it's based off of you're getting the potential capital appreciation from an energy index. We're giving you a pretty high return rate, and it's low correlated to your traditional fixed income space. And the one thing is, we talked about cost. That's another trend. What we're seeing is the cost is coming up. It used to be race to the cheapest, race to zero, but that was kind of the cheap beta products. Now, all this innovation that you just said, it's very expensive for an advisor or an individual to execute some of these strategies. And probably they're, especially if they're an advisor serving clients, they need to serve the clients. So it's providing a solution for them, a time management, but also a way to get some pretty good exposure and possible income in the markets.
James, as it relates to cost, do you get what you pay for within the active space?
I think so. A lot of times, like you were saying, that there was a race to the bottom. Beta is commoditized, so it's really just about costs, right, and how much it trades, and both implicit and explicit costs. But active managers do deserve compensation to deliver, if they deliver on what they promise. That's obviously the key. They have to deliver in order to earn those fees. So, but I generally think that we're not going to see the kind of competition in fees the way we did which was the only differentiator in passive, is not necessarily the only differentiator in active.
And you also make the point too that passively managed investments, they could be compared to active products. What do you mean by that?
Well, so if you think about those words get kind of muddled a little bit, actively managed. So a passively managed strategy can be an index strategy. You can have an actively managed strategy that is indexed. So that's where these terms get a little confusing. Just because it's indexed doesn't mean it is passive, because I think that many of those index strategies are actually trying to beat the benchmark. So if you think about factor products, for example, those are generally trying to beat a benchmark, a traditional market cap weighted benchmark. So I think if you're looking at comparing these products, you should also consider what would be labeled as passively managed, but actually is trying to beat a benchmark.
Yeah, especially with the innovation in indexing as well, right, William? I mean, that's a whole other conversation, but it seems as if you want to be new to the market, differentiate yourselves within the marketplace. Prioritizing innovation has to be a key part of the strategy.
Yeah, absolutely. We think of our approach to ETFs in a number of different channels. One is product. How are you assessing client needs? And certainly in the active space, when ETFs can be thought of as solutions for client portfolios, what are the types of products that you can bring to market to solve those needs? With the other ones being, you need to have the performance that is there, whether you're outcome focused, alpha focused, or access focused, you want to make sure that you're delivering that performance. And then the final leg of the stool is distribution. You've got to have a great distribution strategy to reach those clients with your products.
So let's elaborate that for a moment here. How do you differentiate your distribution strategy?
Yeah, listen, distribution is the battle in ETFs, right? You have to have great digital marketing, right? You have to know which investors are interested. You have to know there's lots of data out there, right? So you have to have a data science unit behind you. Your question before about barriers to entry, I think this is the biggest one, right? You can have a great ETF and no one's going to know that you exist if you don't get all those different parts right. So you have to partner with the big wirehouses, right? Being Morgan Stanley is something we know a lot about, but you need to start with the RIAs, the independents, right? The people that are willing to buy a smaller ETF and take a chance on you and help you grow. And how do you do that, right? Again, you have to find them, you have to know they're interested, you have to partner with them to build products. And I think the distribution part of ETFs is where a lot of the folks who think they can launch one will struggle, because that's where, again, it's expensive, and it's just every piece of that is expensive that I just mentioned.
And what's interesting, Chris, is the distribution and even the Marcoms model, right? That has really switched on its head now that you essentially have to be a data scientist and analyst, as those functions have really changed over the past 18 months to 2 years.
Yeah, and I'm just going to go back to saying, just kind of dovetail off what you said, you have to be committed. You have to be committed in order to have success. And again, one reason I joined Westwood 4 weeks ago, I think this is my 5th week, was the CEO, the leadership, but yet I've started in the ETF business in 2005. So I've seen a lot. But it is the commitment from the firm, from top down. You have to put a financial commitment behind that. You have to have a vision and kind of who you want to be, and you want to stay in your lane. You want to know your strengths, and that's again the ETFs that we currently have. We have a high skill set in energy, and so that's where we started, and we did the cover calls with that. So we know our lane. We know. We have a really good idea of some innovation where we want to get to, and that's around, again, providing solutions. So from Westwood, we're not going to come out and we're not going to be we're going to give you a 1/6 of what you have. You have 5. We're not going to be adding that because we want to add value to the advisors. That's first and foremost, and then the clients.
Yeah, and that's a perfect segue, James. What's next for this space? I mean, it seems as if it's rapidly evolving.
That's a good question, because I think you've seen initially some crowding in certain spaces, like option-based products are almost a quarter of the total universe right now. That seems to be getting somewhat saturated. And then you see other strategies, or other categories rather, that are maybe have a smaller opportunity set right now. So I think as asset managers contemplate their business strategy going forward, they're going to look at what's available in the space. Can I compete? And I think you'll see today we have, like I said, it's about 1,600 ETFs. I wouldn't be surprised to see that number double over the next 5 years easily. And which categories will drive the most development? I think that really is dependent on demand. Right. Whatever's been successful right now, it has been option strategies. That's where you've seen the most development. And as that starts to broaden out, I think you'll see managers look to put out product in other areas.
Yeah, and also, William, it comes down to where is investor demand. We weren't having this kind of conversation around emerging technologies like AI, let's call it 5 years ago. Of course, Gen AI is now part of the consumer vernacular, so you're looking for these types of strategies within the ETF wrapper. So what do you think is next? Or is there any concern that it might get too nuanced when you think about thematics?
Well, I think it comes down to how do these types of strategies fit within an investor portfolio. And what we're seeing a lot of today is, advisors are the primary investor base for ETFs. They're transitioning towards using models as a way to allocate more consistently across their client portfolios. And so whether you're looking to build and distribute your own models, or whether you're looking to get your ETFs onto third-party model platforms, understanding how these types of active ETFs can fit within a client portfolio, I think is going to be a big channel for distribution going forward.
Yeah, I mean, certainly putting on the advisor hat, and Chris will give you the last word here when you think about how the industry could evolve over the next 3 to 5 years.
Yeah, listen, I think one of the things that's going to happen is U.S. investors love U.S. assets, so it's no doubt why we started it with there. But I think eventually ETFs are going to move much more international, right? Access to emerging markets, things you said that are scary, that you don't want to do on your own, both in equity and fixed income. I think you're going to see that. And by the way, it's been a terrible idea for the last decade. The U.S. has dominated. Not so sure the next decade is the same. So I think more international, I think more crypto, and not just the low-cost beta, but again, active portfolios or models about which cryptocurrencies to own, and letting an expert help you do that, someone who's doing research on it. And then listen, I think the long term, the question is, where is the mutual fund industry going, right? Are we going to have ETF share classes? Is this all going to merge into one? There's some legislation around 401ks which keep mutual funds alive, but 5 years from now, are we going to think about ETFs as the dominant player as opposed to the emerging player? I think it's entirely possible, if not likely. So it should be, it's a long time, it should be a fascinating run.
Yeah.
All right.
Agreed.
Appreciate everyone's insight. Thanks for joining us on Trade Talks. And thanks for joining me from MarketSite. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.